Hello everyone, welcome to my newest video. Today I will yet again make a sector rotation video. It will probably be the most useful sector rotation video you will ever see on YouTube or on any platform, because today I'm going to use my indicator. So I made my own sector rotation indicator where I use points here to determine where in the economical cycle we are, and I'm going to teach you how to do it, so stay tuned. But before we start, I really want to encourage you to check out my Patreon blog. Here you can see my almost daily market updates and my weekly blog posts about economics and the markets. You will also have access to my guides. I love all of your support. I couldn't do this without you, and I just want to get more people to join me on my blog. So let's get started. All right, so sector rotation, what is it? I don't want to explain everything from the beginning. I made many videos about that, but basically the markets or the economy moves in a cycle. So, which is also known as the business cycle or the economical cycle, where you have an expansion phase, a boom phase, a recession, and a depression. So it will always be in this order, and one phase of the cycle always follows the other. But you can't predict the markets the same way. You cannot predict what the weather is going to be tomorrow. But if it's winter, you know it's going to be cold. If it's summer, you know it's going to be hot. And the same applies to the markets. If you are able to read the cycle and know approximately where you are, you can prepare and buy and sell based on that cycle. So after I show you this, you will see how useful it is. Making a spreadsheet where you can determine quickly where we are in the cycle is useful for whatever strategy you're using: long-term, short-term trading, scalping, sector rotation. Doesn't matter what strategy. Understanding economics, understanding the cycle is a must-have for anyone investing. And I highly encourage you to either build this spreadsheet yourself or follow me on my blog to see those updates and learn about how these things work. So basically how this works is I have 5 or 6 different indicators like consumer expectation, industrial production, the yield curve, interest rates, inflation, and GDP, which all combined interact with each other and make up the market. So we go through each one basically, and then we can give 1 point for each of these. And based on the total that we have at the end, we can see where in the economical cycle we are. So let's start with consumer expectations. So I linked all the charts that I want to look at down here. So we click at consumer expectation. Here we go. So we can see the graph. We saw a sharp decline because of COVID-19 in March until May. So consumer expectation obviously fell. But consumer expectations for the market is on the rise. So when we go back to our sheet, is it rising? Is it declining? Is it falling sharply, or is it reviving? Well, I would say it's not reviving anymore. I would say it is rising. So we give 1 point here for consumer expectation. Let's move on to industrial production. So for industrial production, I look at the industrial production index, obviously. Let's have a look. So again, we saw a sharp decline with the COVID flash crash last year. And since then, it has been rising, went down a little bit, and became a little bit more steady. So I wouldn't say it's rising too much anymore, but it is stabilized. And we need some more data to see where we are heading from now on. So when we go back for industrial production, we can see here, is it either rising, is it flat, is it falling, or is it at the bottom? Well, let's go back. Well, I would say it is rather flat because we need to see what will happen next. So 1 point here for industrial production being flat. Now the yield curve, I talked about this a lot on my TikTok channel, and this one seems to be the one that people are most interested in. So basically, these are treasury yields. It is the bond market, which is 10 times bigger than all the other markets combined. Nobody talks about this. However, what is important here is so a lot of the market cycle has to do with interest rates. Okay, so when interest rates are low, bond prices go up and bond yields go down. When interest rates are high, bond prices go down and bond yields go also up. When short-term bond yields are bigger than long-term bond yields, you will have something called an inverted yield curve. And as you can read here, an inverted yield curve has predicted the past 7 recessions. Well, it is something that happens after a lot of other indicators. This is just one of the indicators, obviously. But what we can see here is whenever the 10-year or 20-year yields went over the 30-year yields and the yield curve thus inverted, as you can see here, we had a recession about 6 to 8 months after. So what I would be looking closely, besides this indicator, just for yourself, is this number right here. So currently we have the 10-year yield at 1.63%. Whenever this goes over 2, that would be an alarming sign for me personally. But this would be a strong indicator that we are somewhere at the edge. So let's have a look at the data. So it is sharply up. Let's see how it was back in January. Let's add some more data from maybe last year, summer, June. So we can see here, over the months, it is straightening out and was sharply up. But I think it does not get any sharper than this. And it is already kind of flattening out. It is not flattening out totally, but it is not getting sharper than this either. So it is normal steep, but it's not gonna get steeper than this. So this was becoming straighter and straighter as the months passed, but after this, it will just be more flat. So we reached the peak of it being straight, steep, normal steep up. So I would be giving a point for flattening out at this moment in time. Let's move to the next one, and that would be interest rates. So interest rates are your most important indicator. When interest rates are low, that increases economic activity. Banks will lend more to you, people borrow more. About 60% of the market is leveraged money, and that is because people borrow to invest either in real estate, stock market, anything. When interest rates are low, everyone wants to borrow money, and thus that stimulates the economy. When interest rates go up, it has the opposite effect. It slows down the economy. So when we have a look at interest rates, use a TNX indicator, which is the 10-year Treasury note yields, which we kind of looked at before anyways. But when we look here in the past 6 months, let's do 1 year, we can see that interest rates are on the rise, at least for the 10-year notes. And when we go back here and look at interest rates, we can choose from bottom, rising sharply, peak, or falling. There's still upsides here based on past data, and that interest rates are rising sharply. Now it's kind of like flattening out, but they will definitely continue to rise upwards. Another very important thing is the federal fund rate, which is at the moment at 0.25%. Federal fund rate, which is currently at 0.25%. It does not get lower than this. Any lower would be negative interest rates. And the federal fund rate is basically the main rate. When this rate increases, it trickles down to all the other rates, including this indicator right here. We can see that the 10-year treasury note yields are rising sharply, I would say, but as long as the federal fund rate is low, there is still going to be economic activity, and we're still going to be in an expansionary phase of the economy. So this is the main thing you should be looking at. What is the federal funds rate? Is it increasing? Is it not? because if it does change, it will trickle down to all the other interest rates like mortgages, borrowed money. Based on this graph here, we can see that interest rates are rising, are on the rise. And based on here, with the federal funds rate, you can see that it does not go any lower. It can only go up from this now on. So when we go back here and look at interest rates, is it at the bottom? Is it rising sharply? Is it at its peak or is it falling? So I would say it is rising sharply. So we give a point here for that. Let's have a look at inflation next. So for the inflation, I'm looking at the consumer price index. However, this is not the best index to look at for inflation because based on what is called M2s, you could see the money supply directly and then have a look at the velocity of money, which ultimately determines the impact of inflation. You can see the difference in those two and kind of guess what inflation is going to be. Inflation is not when you print money, it automatically inflates prices. It has all to do with the velocity of money and it takes time. So once you print money, it takes about 1 to 2 years for the inflation to be seen and felt by the general public through consumer prices. It is a chain reaction that affects basic materials and commodities first, followed by the industrial sector, which is also a commodity kind of. And after that, those increased prices will impact consumer prices. That's why it takes time. So when you see inflation in CPI, Consumer Price Index, it is basically in hindsight. It is already too late. So we can see here that inflation is on the rise and it's going sharp up. And it says here that it's 4.2%. But if you watch my other videos where I talk about inflation in more detail, you can see that it is way more than 4.2%. However, this is a hindsight indicator. We can see the impacts of the money printing from last year only now, only this month. And this is what we see through CPI. So what we can see here is that it's moving up sharply. So let's go back to our indicator. And is it rising? Is it top? Is it flattening out? Or is it sharp up? Well, it is a sharp up, but it's still rising. So I would say it is still on the rise. Maybe even sharp up because, this has been since March. Maybe back in February or March, I would have said sharp up, but it is continuing to rise. So I'm in between. I don't know, it's either here or there, but I would say it is still on the rise because there's no stop to money printing. It is still continuing. So I would not say sharp up. Sharp up would be if the money printing would stop, but the money printing is not going to stop. There's more stimulus checks coming. There's more stimulating the economy with extra money, and the Federal Reserve is causing inflation on purpose. So, and they said openly that they are okay with inflation being over 3%, and it's well over 3% now, but they're not going to lower rates, the federal fund rates, which we talked about before. The money printing will not end. The federal funds rate will not rise, not for this summer. Maybe at the end of the year, but not for this summer. So I would say it is on the rise. And now the last one, GDP, the most obvious one. So for this one, we have GDP growth and we have real GDP. Let's have a look at real GDP, as I think that's a better indicator of what is going on. So let's have a look. So of course, minus 31% after the flash crash of COVID last year. Then sharp up again, and it continues to be on the rise. So we need a bit more data to see what will happen next. But based on past graphs here, we can see that unemployment is still high and GDP is still impacted a lot by the COVID crisis and has still more to grow. We looked at inflation too, so they want to stimulate the economy. They want this to go a bit higher than it is right now. So when we look at our graph here again, when we look at our indicator here again, we can see that Is it sharp rising? Is it rising? Is it declining? Or is it sharp declining? Well, I would say it's somewhere in between here, because it's neither rising nor declining. To know that for sure, we need more data. It might be going down slightly, but I don't think so. So I would tend to say it is still rising, and it should still rise. So let's put another point up here for GDP. All right, so now we got the totals. We went through all the indicators. We went through all the points in the economy that make up this economical cycle. And based on the totals down here, we can see that we do have 2 points for an expansionary phase of the economy and twice as many points for a boom phase of the economy. So when we look at this graph down here, we can say for certain, after looking at all the data, that we are in a mid-boom phase of the economy. And down here, we can see the sectors that perform well based on where we are in the cycle. So right now, industrials, materials, and energy should perform really well. So we can quickly check this down here in the sector performance check, which brings us to bar chart, which I look at weekly. And when we look at the 100-day moving averages and 50-day moving averages, the more recent ones, we can see a decline in the overall market. But we can see in the 50-day, let's see the 100-day, we can see that at 100% best performing, we have energy, which is a commodity, and we have real estate, and we have real estate, which probably went up because basic materials went up. We saw that with inflation rising and lumber prices going 300%. So people buy up real estate. Plus we have on top of that low interest rates. So you can get debt for very, very cheap. So people get into mortgages more. That will definitely, alongside with energy, industrials, and materials, which are commodities, will increase real estate and the financial sector. That's based on what we saw in our data here. We can see that commodities should be the best performing sectors at the moment, but we could also see that we are in a kind of odd time where we have surprisingly high inflation, where basic materials like lumber goes up and interest rates are so low that it's cheap, that you can get cheap mortgages, of course increasing real estate prices and benefiting the real estate sector and the financial sector. So that's in theory. So let's see what's actually going on. And we can see here that's actually what is going on. So because we see energy at 100%, which is a commodity, we see financials at 98%, industrials, which is a commodity, 97%, materials, which is also a commodity, at 96%, and real estate also at 100%. So we got real estate and energy at 100%. In the 50-day average, we got financials as the best performer and real estate almost as the second best performer, just after materials, which is a commodity. Energy is declining, but it was the best performing sector for the first few months of this year. And moving forward, we saw a decline in information technology, which makes sense because we are moving out of the expansion phase into the boom phase of the economy. And then a sudden sharp up for information technology. This could be for many, many reasons, but I think it is because of the fear of inflation. And how I know this is because utilities went up, and utilities together with consumer staples are defensive sectors that go up whenever there is fear in the markets, which we can see right here. So this sharp up here with information technology, utilities, and consumer staples has something to do with basically short-term changes and short-term fear in the market because of inflation. But inflation does not cause stock markets to crash. Inflation inflates markets as prices go up. It negatively affects some sectors of the economy, like information technology, like the tech sector, but it positively affects other sectors of the economy, like commodities, energy, materials, and the industrial sector right here. And we can see that in the 150-day average. So looking at our bar chart here to double check, we can confirm that our indicator is right and that we are in a mid-boom phase of the cycle. So I want to quickly explain what this upper part here is with the buy and sell orders. So this is for you if you use a sector rotation strategy like I do. It helps you to know what to buy and sell when, depending on where we are in the cycle. So for now, when we are in a boom phase, just like when you plant crops, when you plant, for example, spring onions that will grow in the spring, you don't plant them in the spring, right? You plant them in winter so you can harvest in spring. And just like with crops, the same principle applies to the markets. If you use sector rotation, if you have a good understanding of how the markets work, and which you will have if you have an indicator like this, you can kind of know when it's the best time to buy what. So in an expansion phase, tech will perform really well, like communication services and technology. That's why in this indicator up there, it tells you to sell, because you want to buy low and sell high, right? You can wait for a moment that you like, where it's a good time for you to sell. And that's why it shows sell right here. And before we enter the boom phase, you want to stock up on the commodity sector. That's why I told you to buy energy and materials in this phase of the economy. So this would have been back in December last year or January this year. You would have bought into the commodity sectors while taking profits from the technology sector. And if you would have done that now, you would basically outperform the market, because right now we see in bar chart that technology is performing worse while commodities are performing really, really well. So this is kind of like what you do beforehand, before we enter the phase of the economy. So you want to be ahead of the game, basically. That's the whole point. And here I left a little comment explaining that again. And down here on my indicator, so for sector rotation, so on one side, it's very interesting. So you have a lot of entire YouTube, TikTok, and social media is full of day traders and crypto investors and all these people who look at individual stocks. Well, you have to understand that there is over 35,000 companies out there. If you look at the top 10 performing companies in the past 10 years, and then move the clock forward to the now, and look at the top 10 performing companies today, you will almost see none of the best performers being the same companies that were on the top 10 list 10 years ago. So it requires a lot of research. You have to look at a lot of factors. And if you like doing that, if you like having basically a second full-time job, deciding what company to invest in, then that's great, because there's a lot of potential in making enormous profits that way. And then there's the other extreme, where you are just passively investing and you don't want to understand anything about the stock market. You don't care. You just want to have a safe place for your money to grow. And that's great. That's in my opinion the best way to start. I talk about this in my book too. And just dollar cost averaging into a low fee US index fund will do just fine, and you will outperform 90% of investors just using that strategy, dollar cost averaging into a low fee US index fund that tracks the S&P 500 every month. You will outperform 90% of investors. It's a great strategy. However, you will miss out on potential gains for being so lazy. Sector rotation, in my opinion, is right in the middle of the two. I don't have to look into individual companies or individual stocks. All I have to do is I have to look at the sectors and their performance, and I can invest into the entire sector instead. So based on the information I get from my spreadsheet, I have the ability to determine when is the best time to buy and sell into the entire sector instead of specific companies in that sector. And that's why I have this list down here. It uses only Vanguard ETFs for you to invest into these sectors. So that's pretty much it. That's the entire indicator. I call it the Goldie indicator, and I'm very proud of this. And again, if you are interested in updates of my indicator every month or every week or so, I will post them on my blog, which I highly encourage you to check out. I will put the link below the video. And if you're a new investor, please check out my book, A Guide to Almost Foolproof Investing, so you can avoid the mistakes that I made when I started investing. And it also has an introduction section to sector rotation. And I'm very proud of my book too. So I would be really happy for all your support, because only through you I can make this great content. And I hope that one day I could just do this full time and be more personal with all of you, with my fans, and help you on your investing journey. Thank you very much for watching, and take care, and I see you next time.